Hello, everybody, and welcome to Chapter 10. I hope you're excited for some fun learning. We're going to take the variance discussion that we had in Chapter 9 up a notch and basically break down our flexible budget variance into its two components, which relate to a price component and a quantity component. So that's really what this chapter is all about. So let's get started. So the first thing we're going to talk about is the concept of standards. All standards are really budgets on a per unit basis. So there's pricing standards and quantity standards. The price standard is how much we should pay for each unit of input. What are the units of input? That's direct materials, direct labor, and overhead. Quantity standards would be how much of the input we need. So as an example, the price standard for direct materials could be $1.50 per pound. The quantity standard would be how many pounds of direct material we need to make our final product. So again, the standard price per unit is going to be the final delivered cost of materials, net of any discounts. The standard quantity is summarized in the bill of materials. It's how much material we think we're going to need to make a given unit. For direct labor, there'll be a standard rate per hour that we expect to pay our employees, as well as a standard number of hours that we think they're going to take to put the product together. And then for variable overhead, we're going to have a price standard, which will be the rate for the variable portion of the predetermined overhead rate. So it's the variable part of the POHR, the predetermined overhead rate. And then the quantity standard would be the quantity of the driver or allocation base, usually direct labor hours, but it could be direct labor dollars or machine hours. It's whatever the driver is for that overhead. So if we put all those concepts together, we can create what's referred to as a standard cost card. And a standard cost card just takes the standard quantity that we believe we need to make a product and multiplies it by the standard price in order to get the standard cost to make one unit. So as an example, for direct materials, we believe we're going to take 3 pounds of material at $4 a pound. So to make one unit, it's going to cost a total of 12. Likewise, for labor, it's 2.5 hours at a labor rate of $14 an hour. So the total labor that goes into the product is 35. And then variable overhead, if it's based on labor hours, we're going to have the same quantity that we did for direct labor, but our rate's different because this is the variable portion of the predetermined overhead rate, and that'll give us the variable overhead component. The fixed overhead component, which is the last piece of our product cost, we'll cover in the appendix. Fixed overhead's a little different because it's not variable. It's a different type of cost behavior. So we're going to keep that discussion separate. So all the standard cost card tells us is the standard quantity of the inputs that we need, and then it multiplies it by the standard price of those inputs to arrive at a standard cost per unit of final product. Standard cost per unit for direct materials, direct labor, and variable manufacturing overhead can be used to compute activity and spending variances. Spending variances become more useful when we break them down by the price and the quantity pieces. So if you remember in Chapter 9, we calculated the spending or revenue variances, which I also told you are referred to as the flexible budget variance, by comparing the actual results to the flexible budget. Now what we're going to do is break down that flexible budget, aka spending variance, into its price and quantity variances in this chapter to get better information. So we're going to take the overall flexible budget or spending variance and break it up into its price and quantity component. The price component is going to be the difference between the actual price we pay per unit and the standard price. The quantity variance is the difference between the actual quantity of the input that we use versus the standard quantity that we expected to use. Remember, standards is just a synonym for budget. Price and quantity standards are determined separately for two main reasons. One is that the purchasing manager is responsible for raw material purchase prices, but the production manager is responsible for how much of the materials are going to be used. So it's important that we break down the overall variance so we can hold the appropriate manager accountable. The buying and using activities occur at different times, so raw material purchases may be held in inventory for a period of time before they're used in production, which is another reason why we want to break down the pricing and the quantity standards, because the price standard is going to be based on when we buy the goods. Quantity is going to be based on when and how we use those goods in production. Our variance analysis, when we break up that flexible budget or spending variance into price and quantity components, we're going to have a materials price variance and a materials quantity variance. For labor, instead of a price, we call it a rate variance, and the same for variable overhead. Instead of a price variance, it's called a rate variance. It's calculated the same way as a price variance. It's just another word that means the same thing. So we don't say, oh, I'm paying my employees a labor price. We're paying them a rate. That's why we use that terminology. And likewise, for materials, we have a quantity variance, but for labor and overhead, we call it efficiency, because if our employees take too much time to produce a product, we deem that to be inefficient, as opposed to if they're doing a good job, they're efficient. It's just semantics. The calculations are all going to be done the same exact way. And here's exactly how it's going to be done. So I'm a big fan of this model. This is what I'll be using to calculate all of our examples. There's also an algebraic model, which I'll show you later, or I might show you now if I get excited. But I want you to understand this. So the way it's set up is it's actual quantity times actual price, actual quantity times standard price, and the standard quantity times the standard price. This SQ I call SQAAP, which stands for standard quantity allowed for actual production. That's the standard quantity allowed per unit times the actual production during the period. This is effectively representing our flexible budget. This obviously is actual, and I told you that our spending variance in Chapter 9 was the difference between actual and flexible, and what we're doing in this chapter is adding this middle column, which has no real name that I can give it except for middle, in order to break up the overall spending variance into its price and quantity components. So that's important to understand. So again, these are all going to be set up this way. No matter if it's direct materials, direct labor, or overhead, it's the same format and setup. Actual quantity times actual price, actual quantity times standard price, standard quantity allowed for actual production, SQUAP, as I like to call it, times standard price. And that'll allow us to get all of our variances. The hardest thing in this chapter you're going to find is picking out the numbers and putting them into the right variable. So you have to read the questions carefully and make sure you're putting the numbers where they belong. As we go through our examples in the PowerPoint, it kind of lays out the items for us and makes it kind of easier to determine what goes where. That's why it's important you do some practice problems that are on Canvas, because when it's not all laid out pretty for you in the same exact format each and every time, it could get a little more challenging. The process is exactly the same, but being able to properly identify the variables is going to be extremely important. I said if I get excited, I might give you the algebra. I don't like the algebra, but it's easy to figure out what the algebraic equation would be. All you got to do is look at what's the same between the two columns. So you can see between column 1 and column 2, it's the quantities that are the same. So we can put that outside the parentheses, and then we get the algebraic version of this, which is that the price variance equals the actual quantity times the difference between the actual price and the standard price. So the one good thing the algebra points out is what's different between the columns. What's different between column 1 and column 2 is the price. Actual quantity is a constant. So that's why comparing column 1 and column 2 gets you the price variance. On the other hand, what's different between column 2 and column 3 are going to be our quantities. So the constant this time is the standard price. So the standard price goes outside of the parentheses, and then it's actual quantity minus standard quantity that will go inside the parentheses. And again, that's why you get the quantity variance by comparing column 2 and 3, because what's different between column 2 and 3 are the quantities. I don't particularly like using the algebra. I like setting up my 3 columns each and every time to get my variances. It makes it easier for me personally to identify if it's favorable or unfavorable, which we'll talk about as we go through some of the practice problems. But everybody learns differently, so I leave it up to you to decide how you best want to approach these problems. No matter what, using the 3-column approach or using the algebra to get the price and the quantity variance, you should arrive at the same answer. The actual quantity that we're using in these columns is the actual quantity of direct materials, direct labor, or variable overhead that's actually used. The standard quantity is the standard allowed based on the actual output for the period. That's why I call it SQUAP, because it reminds me what I'm actually figuring out. I'm figuring out the standard quantity allowed based on the actual number of units that were produced. Remember that column 3 is supposed to represent the flexible budget, which is based on actual activity. The actual price is the actual amount that we paid for the input that we used, versus the standard price is the budgeted amount that we believed we would pay per unit of the input that we used. So what we're going to do for the vast majority of this chapter is apply these 3 columns and go through several different examples. So that's what we're going to do in our next segment.